Okay, thank you, Stephen and Jamie. I'm just going to get a quick drink. Okay, so as Jamie said, I'm going to talk about some of the technical details of the American Monetary Act. Pretty much exactly how we get from where we are now to where we need to be. But just before we get into the details, I just want to, there was supposed to be a talk about how money is actually created. I just want to very briefly explain that so you know what the problem is and then we know how to fix it. So in essence, the way that banking works, they know that in any particular time period, the amount of money being paid in will be roughly equal to the amount that they have to pay out. Now, some days there's a small difference. Basically, what this means is that the net withdrawals on any one day is usually close to zero, but on some days there's a small difference. Now, they keep back a small percentage of all the money that's paid into the bank in order to cover that small difference. It's what we call reserves, basically. What this means is that if a bank has 100 billion in deposits, it's very unlikely that the total withdrawals within any one time period will reach 10 billion. And that leads to the banks assuming that the other 90 billion is effectively idle, which means that the depositors don't require it because they don't seem to be using it. This leads to the fractional reserve banking system where this 90 billion is lent. It's depositors' money, but it's lent out, and then it's relent again and relent again. Every time it's counted as new money, and this is how money is created under the system. So basically, the essence of banking is providing the bank has enough reserves to meet the maximum likely withdrawals within any one time period, they can go ahead and use the rest to issue loans. So this is the problem that we need to fix in reforming the system. So very quickly, like we've been over this a little bit, but just it really is only a matter of time now before this reform needs to go through. We've passed the point where we can keep it as it is. I did some calculations. If Americans were to stop taking on debt today, borrowed nothing, it would take until 2085 to clear the existing debt. But it's even worse than that, because there's this impossible equation. We have the banks, and we've got the population of the USA. This is all the money that the USA has. It's about 14 trillion, depending on which statistics you look at. And this is all the debt when you take the interest into account. You're looking at around 150 trillion. Now, if you were to take all the money that we have and pay that to the banks to reduce the debt, it doesn't make much of a difference. And then the only way that we can get money to continue repaying that debt is by borrowing it from the banks again. So the only solution to this problem, exactly, we can't get out of debt by borrowing more money. It's impossible. So the only real solution to this is to create debt-free money, which is what will happen under the American Monetary Act. Okay, so a quick history of the reform that I'm going to take you through. It started life as the Chicago Plan back in the 1930s with Irving Fisher. Then James Robertson and Joseph Huber, who have already been mentioned, took that and developed it a little bit further. About the same time, Stephen Zalanger and the AMI were coming out with very similar ideas. And then over the last few months, Jamie Walton and Mike Black in the UK and myself have been working through some of the finer details of this and working out every step of the process that we need to get to make this American Monetary Act work. So what do we need to do? The first thing is we've got to prevent the banks from creating money. We all know that that's the root of the problem that we're here to discuss this weekend. Secondly, we need to find a better way to create money and a way that isn't inflationary as well. We need to ensure that the transition between where we are now to where we need to be goes smoothly. And then finally, we want to reduce our current debt burden. We don't want to keep living the standard of living that we're living now. We want to try and clear that debt. So, first step, preventing banks from creating money. So, this is a problem that has puzzled a lot of people, but the actual solution is very simple. You simply specify that every credit to one account must be matched by an equal debit to another account. What that means in plain English is if you want to put money into one account, you need to take it out of another. Now, where that differs from the current banking system is that the current banking system can take 90% or more of the money that you pay in and use it to make a loan without ever actually deducting that from the balance of your account. So once you start applying this rule, it becomes technically impossible for the banks to create money. But then the question is, if you need to take the money out of one account in order to put it into another account, whose money do you take it out of when you want to fund a loan? So this, from the perspective of the members of the public, the banking system will seem to be very similar after the reform as it is now. There's a few small differences. So let's say you had $100 and you want to put that into the bank. After the reform, you're going to have two choices. Firstly, you can give it to the bank and you can say, I want you to keep it safe for me. And by safe, we're talking about Swiss bank safe rather than Washington Mutual. Alternatively, you can give it to them and you can say, I want you to invest this for me and I want to earn a return. So these two broadly correspond to what you currently know as checking accounts and savings accounts. Okay, so let's just go through these in a little bit more detail. Checking accounts will be very much similar to the way that they are now. They still provide your payment services, your ATM card, debit cards. Your salary will be paid into them at the end of the month. What is different is that they're now 100% reserve, which means in plain English, if you put the money into the bank has to keep that money. Another way of saying that is off the balance sheet. But the bottom line is that these funds cannot be used for loans. So when your money's in your checking account, it's actually there. It's not being lent out to somebody on the other side of the world or somebody, a subprime borrower, for example. There'd be fees charged for that service, similar to the way it is now. Okay, now savings accounts. These funds can be used by the banks to make loans. The small difference from the current situation is that there won't be any instant access savings accounts. The key point is that if you're giving your money over to the bank for investment, you can't have access to that money while they're using it for the investment. How it would work practically is you'd either choose a maturity date, you set a date in the future when you want the money back, or you just set a notice period and you say, if I need the money back, I'll give you 60 days notice. That's similar to a lot of savings accounts now, but it does mean there'll be no instant access savings accounts. And that pays interest or whatever is agreed with the bank. Okay. So essentially, you're handing your money over to the bank and allowing them to use it for the purposes of investment. Okay. So there's one key change here, which is that money is no longer in two places at once. It can't be in your checking account at the same time as it's being used to help somebody buy a house. The method of accounting that banks use can be quite misleading. And we sort of return into a way of seeing money as pools of money, and the bank's accounts will reflect money that they actually have rather than future income. Okay. Okay, so how do banks make loans under this system? So we have a commercial bank here, and we have a customer that most of you will probably know. Let's say Homer wants to pay in $100 into his bank. So he puts it into a checking account. So his checking account balance is now $100. Then he decides that he's not going to need this money until sometime next year. So he wants to save it and try and earn some interest. So he opens a savings account with his bank, transfers the money into there. Now what the bank does at this point, okay, sorry, when he transfers the money, he agrees the date when he wants that money back, the maturity date. So what the bank does at this point is transfer it into something called their investment pool. The investment pool is simply a pool of funds that are available for investment. We've gone with the cryptic banking terminology that they use so often. So the money's now not in the savings account, it's in the investment pool, which means the bank can use it to fund a loan. So let's say a local business comes along and wants to borrow $100. So the bank actually transfers that $100 to the checking account of the local business. Now let's say Mo's Tavern goes and spends that money on marketing, gets more customers through the door. That allows him to pay the loan back to the bank, back to their investment pool. So now the bank pays $105 back to Homer, straight to his checking account, and the $5 profit is theirs to keep, essentially. Okay, so just so you can see how this works over the entire banking system, you have multiple, checking accounts here. You have the investment pool. You probably have some of the bank's own capital. That's their own, maybe shareholders' funds or their retained profits that they're using to invest. Some depositors will make investments first. They're opening savings accounts and transferring their money into the investment pool. The bank might put some of its own money in. You can see the investment pool's getting bigger. They've got more funds to invest now. So they go and make a load of loans to other borrowers. These borrowers repay the money back to the investment pool with the interest on top. The bank takes its own funds and profit out of there, repays the original lenders, and then takes its profit. And at no point in that process is any money created. It's only been moved from one place to another. Okay, so this prevents banks from creating money. The next thing we need to do is find a better way to create money. And this is as specified under the American Monetary Act. Initially, the monetary authority determines how much new money that Congress determines how much money the economy needs, and then advises Congress. Congress decides on what the newly created money will be spent on, and it authorizes the Treasury to create however many billion they decide on. So the key thing is that the US Treasury actually creates money now. It's no longer the private banks. So let's just see how they do that. We have the US Treasury / Fed now. They're essentially part of the same institution. And the central government has an account with the Fed. Now, all they need to do to create money is simply add that number to the account. It's as simple as going into an Excel spreadsheet and typing in 15 billion. It happens as quickly as that. So, then so they've created this 15 billion in the central government account, and now the central government transfers those funds to the accounts of its state and local government agencies and federal agencies. Okay, so gives the money to those various different government departments, and then they spend it into the economy as part of their normal spending. So this is the process through which new money gets distributed into the economy. The central government will pay the state governments and the federal agencies. State governments pay their employees. Federal agencies pay their employees. And both the state governments and the federal agencies will use some contractors, and in turn the contractors pay their employees. Now all these people, which probably amounts to tens of millions of Americans, will go and spend that money into the real economy. Now this is a key point that I'll come back to later, but you've got to realize that the money is being distributed by tens of millions of people here rather than through the housing market as it currently is at the moment. We'll come back to that. Okay, so where are we now? Prevented banks from creating money. We've got a better way of creating money. Now we need to get from here to there without causing any disruption in the financial markets. And as Jamie and myself have been working through this, we've been very keen to make sure that there's no unintended side effects, because even though there's an attitude that you might want to punish the bankers, the reality is if you cause any disruption in the financial markets, it tends to hurt those people who've invested in their pensions more than anybody else. So, the transition. There's two stages to this transition. There's a legal enactment of the Act, which happens essentially overnight on a specified day, which we'll refer to as a conversion date. then there's a much longer process of getting out of the debt-laden situation that we're in at this moment. Okay, so on this conversion date, whenever it is, maybe 12 months after the American Monetary Act is voted in, checking accounts become subjected to this 100% reserve. Savings accounts essentially stay as they are, but they're subject to the new regulation. Anybody who has an instant access savings account, which is one of those accounts where you can go in and just say, I want to withdraw all my money right now. Those people will be asked if they want to turn it into a checking account or if they want to apply a maturity date to that. Okay, so now let's look at how the banking system as a whole works. We've got the Fed here, and just in case there's any confusion, what the Fed will do under the Treasury is essentially manage the banking side of things. Now, the Treasury will create money, but the Fed actually has all that expertise in how the banking system works, so they'll continue to oversee that. So we have the Fed, and we have Bank A here. Now, Bank A has a number of accounts at the Fed, as they do at the moment, but slightly different accounts. It has an operational account. Now, that's going to be its general purpose account where it can keep its own funds. It has the investment pool, which is where it stores the money that customers have given to it to invest before they've actually been invested. And there is something called the customer funds account, and that's the total of all the checking accounts. So if you've put your money into a checking account, it's really going to be stored in the customer funds account at the Fed. Okay, so what you'll see is that essentially all money is now stored at the Fed, with the exception of cash. What Bank A actually has to do with its own systems, Bank A will have a computer system which says, of all the money that we have at the Fed, $100 belongs to Mrs. Smith and $12,630 belongs to Mr. Jones. They'll also keep a record of how much people invested, when they invested, at what interest rate, and when they expect to be repaid back. So there really isn't any scope for banks to create money under this system. So let's just, unfortunately we're going to go into a bit of accounting now, but we'll just show you how you convert a bank from this current system to the new system. So, has anybody seen this before? This is what the bank calls a balance sheet. This is how they record their money coming in and money going out. On the right-hand side, the remainder is money that's been paid in the past, and the loans here is money that's been spent, lent out already. So it's no longer in the bank. So what this means is that of the 100 billion that was paid in by depositors, the Fed only really has 10 billion. The remainder, which is what they call excess reserves, has been used to fund loans. Okay. So the way that banks account for this at the moment, they would say they have 100 billion of assets. The money supply also is this side of things. So that would be 100 billion in that bank. In reality, there is only actually 10 billion of money, and if all the customers went to the bank on one day and tried to reclaim their money, the bank would only be able to repay 10 billion before it ran out. It can only meet 10 billion of its liabilities. So this method of accounting confuses real money, which is the operational account at the Fed, although without going into the legislation, that might not even be real money these days. It confuses real money with income that's going to be spread over around 30 years. That's loan repayments. It's not money that's there now. It's money that they're hoping to receive over the next 30 years. And also future outgoings, which could be redeemed tomorrow if there's a run on the bank, or it might never need to be repaid. Okay, so let's sort of take that and present it more accurately so we can see what's really going on with the bank. And what I've done is separated real money from money flows. So real money, we've got 10 billion in the operational account of the Fed after the reform. We've got 0 in the investment pool at the moment. And then we've got this customer funds account, which, if you remember, is where the checking account money goes. And that is also 0 at the moment. with regards to the money flows, we've got the future income, which is the loans that they expect to be repaid, which is 90 billion. And then the future outgoings, there's 50 billion from their checking accounts and 50 billion on their savings accounts. So this is money that at some point they might need to repay to their customers. Okay, we're not including interest just for the sake of simplicity. Now we've got a problem because this figure here, the 0 billion, should really be 50 billion, which is the total amount of money that was paid into deposit accounts. If you remember, like one of the rules that we're specifying in the Act is that all checking accounts need to be 100% reserve, which means if you've paid the money in, it should be there in the bank. That's not the way it works at the moment. So this number here needs to be 50 billion. So there are a couple of ways the banks could get that money to meet the requirement, but we don't want them to do most of the options available to them. We don't want them to call in loans early. That would cause an economic crisis. We don't want them to sell off any assets, likewise. We don't want them to try and sell more shares into the bank. That's, again, going to disrupt the stock markets. All these things can cause instability in the economy. It's not what we want to do, and it's not the aim of the reform. So what happens is the Treasury will step in and give the banks a 50 billion loan, or a loan equivalent to the amount of checking account deposits that it has. What this means is that the bank, which had a liability to checking account customers, now has a liability to the Treasury of 50 billion. From this point on, we don't record checking accounts as a liability to depositors. Okay, and the bank has now met this 100% reserve ratio on checking accounts. So what that means is if the day after the reform, if every checking account customer went back to that bank and said, I want my money back, they could pay it all back without going bankrupt. It would be no issue for the bank, really. It would probably be the end of its reputation, but the bank would still survive. Okay, yeah. Okay, so what's the financial impacts on the bank of this? When you start talking about this reform, a lot of people immediately say it will bankrupt the banks. But when you actually look at the accounting, it's not such, well, it doesn't have that impact, as we'll see now. The impact on assets, before the reform, assets were 10 billion. Real assets were 10 billion. After the conversion, the bank's real assets are still 10 billion. That's the 10 billion in the operational account there. The impact on future income, the bank was expecting 90 billion in loans to come back in. After the conversion, its future income is still 90 billion in loans. That's there. Okay, liabilities, that's the money that they will need to repay to their customers at some point. Before the conversion, that was 100 billion. After the conversion, it's still 100 billion. So when it comes to the accounting, there's no real financial impact on the bank. But there is one major change, and it's intentional, and it's a key part of the Act. Before the conversion, these liabilities, this money that they owed to the customers, checking accounts and savings accounts, would probably never have needed to be repaid. As somebody said earlier today, we all need to keep our money in the bank. The banks, even if you withdraw from one bank, it will be paid into another bank. So it's pretty unlikely that they would ever need to repay that money. In contrast, after the reform, that liability to the Treasury does need to be repaid. Now what we're doing here, we're actually reclaiming the money that the banks have created. If we, the current money supply is around 14 trillion. By some estimates. Now most of that money is created by private banks as debt. Now if we simply repay all our debt and we allow the banks to keep that money, it's a 14 trillion windfall for the banking sector. They will simply relend it back to us again, which could create another housing boom and another debt bubble for the next 10 or 20 years. So what we want to do is convert this bank-created money into what the American Monetary Act calls US money. So this is how we reclaim the money that the banks have created. By giving this 50 billion loan to the treasuries, to the banks, so that they can meet our 100% reserve requirement here, and then requiring them to repay it. Okay. Now what this means, the magic in this is that over the entire banking sector, the sum total of these bridging loans made by the Treasury to banks will be roughly equal to the total money supply of the US. All that money needs to be repaid. Essentially, we're asking the banks to repay all the money that they created. In another sense, we're swapping 14 trillion of bank-created money for 14 trillion of government-created US money. However, we haven't created a debt-free economy yet. We're not quite at the end. Okay, so back to what we need to do. We've prevented the banks from creating money. We found a better way to create money. We've ensured the transition goes smoothly. And now we need to reduce the current debt burden that we're in, which currently stands in the region of 60 trillion, probably 150 trillion if you factored in the interest over the next 2 or 3 decades. Okay, so let's look at how this process is going to work. How are we going to get ourselves out of the current debt trap? We've got the American public here and the banks. Now, we're going to continue repaying the debt that we already have. We'll pay it back to the bank. A certain proportion of that money will be redistributed back into the economy in the form of either lending or paying the wages and other expenses for the banks. But part of those payments will actually be paid through to the Treasury via the Fed as a repayment on the loan that the Treasury originally made to the bank. Now the Treasury credits that to the central government, and then the central government spends that money back into the economy. So just in case you forgot that diagram from before, straight through the state governments, the federal agencies, to their employees, and then back into the real economy. So that's when we talk about spending the money into the economy, this is a process. The one other aspect of that is the federal debt, or the national debt. A certain proportion of the money that it gets back from the Treasury will be used to pay down the national debt. The money that it spends on paying down the national debt probably goes disproportionately to the financial sector. Some of it will go back to the public in terms of we're paying off debt to the pension funds, and the pension funds then pay the pensioners their living expenses. So that goes back into the real economy. And then the rest of that money will go back into the bank to clear the remainder of the federal debt. Now what you've got here is a cycle. As we pay the money back to the banks, that comes back to the Treasury, back to the government, back to the public, through into the real economy, and then back to us. So we can use the same, at the moment we've got this impossible equation where the total amount of debt to be repaid is far, far greater than all the money in existence. There is no way around that unless we're creating more money. But what we've got here is we can use the same money over and over again to repay this debt. Now over a period of maybe 20 or 30 years, we'll clear all the existing debt, and we'll be gradually transitioning to what we could call a debt-free economy. And it's not debt-free in that there won't be any lending. I might still want to lend you $100, but it's debt-free in that the money supply won't all be issued as debt. It will be issued debt-free. Okay, so that's a brief overview, and there's quite a lot more technical detail. So I think Jamie and I will be publishing something shortly after. But I just want to quickly go through the few of the benefits that we'll get from this reform. So I've called it the new world because it will be totally different. So inflation, like when you start talking about the government creating money, a lot of people will say it's going to cause inflation. Now the reality is that inflation will be less after the American Monetary Act than it will be under the current system. Now the reason for this is the way that banks create money is pro-cyclical. What that means is when the economy's doing well, everybody's spending, there's lots of money coming into the banks, they lend it over and over again. And the higher up we're getting into a boom, 1 minute, okay. The more we're going into a boom, the more they're lending. In a recession, they create too little. Under the new system, we can control the amount created, and we can set safeguards to limit money creation to a particular, whatever percentage it needs to be. There'll be no more price bubbles in housing because all the money that comes into the economy doesn't need to be distributed through mortgage loans. In contrast, government-created money is evenly distributed across the economy rather than all being spent on housing. And there's no need for all prices to factor in an interest payment, which some people have estimated to be 50% of the cost of everything. Okay, we'll have a more stable economy because we don't have this pro-cyclical lending. Skip through this. Okay. Sorry. And then, okay, 10 billion. Oh yeah, well, one important thing to realize is that when banks will try and make out that their lending is good for the economy, they lend this money into the economy and it fuels a boom on Main Street. It's not, because if you lend 10 billion and you charge an interest on that, the next year you need to take back 11 billion. What bank lending does is actually take money away from Main Street and from the real economy. It diverts more of money that we would have had to spend into interest payments back to the financial sector. In contrast, government-created money doesn't do that. It's a billion created by the government is a billion. It doesn't take any money out of the economy. It's a real stimulus. Okay, nearly there. The government-created money will allow us to reduce our debts. What this means is that we're going to be less dependent on debt and credit. We don't need to be talking about trying to get credit flowing anymore. As we reduce our debts, we increase our disposable income. With your disposable income going up, there's less need to borrow. And the other side of this is that there won't be any shortage of credit. We're not so dependent on credit, but there will also be less shortage of credit for the reason that higher disposable income means that we have more money that we can save. We're going to pay more into our pensions. We're going to pay more into bank savings accounts. As the debt is paid off, more money is available for lending. Okay. Yeah. Okay, so in summary, we prevented banks from creating money. We found a better way to create money. We ensured the transition goes smoothly, and we've reduced our current debt burden. So, any questions?